It is March 24th, and here is a look at ExxonMobil. It got an indication yesterday at 35.50 about that it's ready to go up, so we got a buy signal. And I would put a stop right underneath this most recent low under $30 right here in case it continues to go down. But if the stock did bottom right here at about $30, I would expect it to go up like this, maybe to 50, where this last breakdown level was. Perhaps maybe it goes even a little higher after it pauses at 50. It could go as high as even, say, back up to here, 60. And we'd look for that to occur over a time frame of several months, maybe the whole summer. But there's still a lot of supply here, right at 50, so I don't think 60 is going to be easy, but I think it eventually could get back up there because it is ExxonMobil. Thinking about downside, the stock could always go like this, down beneath 30, so we want to use a stop right here at the red box. But this divergence here with the RSI trending up shows me that this could be a bottom here at $30 because the RSI is trending up while the stock price has been trending down like this. So that's a good indication that this is at least a short-term bottom. So that's a good overview of the technical reasons why I want to keep taking a shot at getting long ExxonMobil here. And now I'm going to go into the fundamental reasons of how to trade it. So here are some fundamental stats for ExxonMobil. Something I like to focus on is the PE ratio, which is right here, and the PE 10 specifically, which is the average earnings over the past 10 years relative to its current price. The lower this number is, the cheaper the stock is. And another thing I like to look at is the dividend yield. This one is above 9. Another metric is the price to book. This is below 1, so that means it's cheap as well. Of course, it could always mean that Exxon has to take a hit to 20% of equity, which would make that book value actually 1 right now. And I like to look at its total debt, which is pretty low relative to the size of the company as a whole. It's only got $45 billion in debt relative to this market cap of $156 billion. So it's got a lot of room to take on more debt if things go really bad from here. But it's not all good. Now for the bad stuff, its EPS growth is obviously down because oil is down. So it's not growing earnings, which is always bad. Okay, so that's a look at the fundamental stats. Now let's take a look at the operating metrics. Okay, so here we have an ROE decomp, otherwise known as a Dupont Analysis. So negative 61% is the return on equity over these years from 2013 to 2019. You can see it goes from 19 down to 7 due to the price in oil drop. Over the same time, financial leverage has gone from 2 down a little bit to 1.8. So that's good, all else being equal. It means its debt as a percent of its assets has gone down. But like anything, there are some caveats. We don't really know if the assets are worth what ExxonMobil says they're worth. Next, we take a look at its asset turnover here. It's gone down 44%. So that means the revenue it receives for the assets it holds on its balance sheet has gone down. Obvious, again, due to the price of oil decline. So next is its Ebit Margin, the earnings before interest and taxes it gets as a percentage of its revenue, has gone down. A decline of 38% from 2013 to 2019. So this is the why of the ROE going down 61% over this time frame. It helps give us an idea of the operations of ExxonMobil, why the decline in price is. So now that we got a better understanding of what we're buying when we buy ExxonMobil, I'm going to look at how we set up the trade. So here's my trade template spreadsheet I've got for all my trades. All the ones in blue are inputs. So we start with the share price here of Exxon. We put in our stop price right below 30 right here. And all these are then inputs that you can put in blue, and it spits out all these metrics here, which gives us basically our appropriate shares of 8, which is really small, but that is based on all the inputs of risk we have. We put in our logical sell of $60. $50, which may or may not be realistic, but that's the best we can do. And it gives us our value gain of 3.6, which is okay, but it is certainly not great. We ideally want our trades to be around a 2 to 3 R value gain if we can consistently have an expected return. I'm going to try and get that R value a little higher by going into the spreadsheet. The reason it's so bad is because of this down 19%. The delta negative 19 here is the difference between our entry price 35.75 and our stop price 29. So ideally we don't want this to be more than 7%, so I'm going to change this buy price in here from 35.75. I'll try messing around. How about $32 and see what that gets me? I enter that, and so our delta is 9. Still not good. We want it to be 7. So I will change that again from 32. Let's try something a little lower, 31. That gets us down 6. So that's a little bit less than we want. We can afford to take a little more. So I will try a little bit lower than 32. And that doesn't get us to where we want. So we try one last time. I think 31.25 will do it. So 31.25, and there we go. Our delta is exactly 7%. Our stop is 7% from our entry price. So that is where we want it to be. So now we just go down to see what our R value is after that, and we get a much more respectable R value gain at 12.8. So that means our reward is 12.8 times our risk. So that would be a much better trade to get into ExxonMobil at 31.25 from a risk-reward standpoint. And I don't know if it's a high probability of Exxon coming down to 31.25 to get in to buy. And I don't know if it did come down to 31.25 if you'd actually really want to buy there, because that is not something I would expect to happen if this was going to go back up to $50 or $60. But that is based on my personal risk-reward metrics that I've got, and you can always play around with those in the spreadsheet to get into something that will work for you. All right, well, that is it for now, and thanks for watching.